So, gentlemen, we have a question from a client that asks, I know, is it a client?
Yeah.
Okay. I read it.
Start over.
I read it.
You don't need to reslay.
Get that one.
So, gentlemen, we had a question from a client this quarter asking about, anxious about volatility and their risk tolerance. And I wonder, when you field those types of questions, how do you address that?
I think it's an important question because I think that you have a problem if your investment portfolio is so risk averse that you can never get anywhere, or you have a portfolio that is so risk heavy that you can't stand it. So the question is, how do you physically handle that? How do you manage, and how is your investment portfolio structured so that you can meet both of those sides?
And the way we've traditionally done it here at SR Schill, and I think is the most effective way that I know of that it's done anywhere, is to diversify the client across a number of different segments of the market, so that some things may be going down while other things are going up, or if things are going down at the same time as the market is dropping, maybe it won't go down as much.
How do you know that some things will be going down and others going up? What kind of diversification are you talking about?
Well, we are choosing segments of the market that historically show various levels of correlation to one another, right? And so we have, in addition to large U.S. stocks, right, and small U.S. stocks, international stocks may be doing something different. REITs or commercial real estate may be responding differently. Bonds are very much historically a good diversifier because they tend to move opposite to what the market is doing in a lot of respects. And they tend to reduce the overall volatility of the portfolio because of that.
And of course, using our modeling technique, you can definitely see the results in the Monte Carlos that we produce for our clients. You can see the results if you add more volatility or if you take volatility out. And again, I would emphasize again the importance of having enough volatility to reach your goals, but not so much volatility that you won't stay the course.
And gentlemen, what, in terms of specific examples over these last volatile quarter, what are the sectors that you've seen that have helped ballast and sort of show the virtues of diversification?
How
Well,
about gold?
Gold has been very good.
Gold has been an absolutely wonderful diversifier for us.
Yeah.
And we've utilized that as a portion of our natural resources, and it has done very, very well for our clients. In addition to that, as we're just looking at the overall allocation that we have, while U.S. stocks may have been suffering at times, but then rebounded, international stocks kept powering through. International had an extremely strong quarter.
Yeah. And if so we have clients are invested in all these different sectors, and then on a quarterly basis, one of the things we do at these meetings, we decide on a relative weight whether to overweight, neutral, or underweight. And over the last quarter, what areas have we been overweighted for the second quarter of 2025?
Well,
Gold.
With gold in the portfolio, we overweighted international during the past quarter, which I think both gave us a good insulation, if you will, from the volatility that we had with the tariffs and all of that craziness that went on.
And within our bond portfolio, we were skewing things towards the shorter end of the curve rather than the longer end of the curve, which also ended up working out very well for our clients.
And what's the rationale? What was the rationale for doing that?
It's an acknowledgement that bonds tend to move based on what's going on with interest rates. And interest rates, as they go up, bonds will go down and vice versa. It's an inverse correlation. The longer the duration of the bond, the more interest rate sensitive it is. So if you're anticipating a move in interest rates, particularly a move in interest rates that could be going up, you don't want to be heavily weighted towards the longer end of the curve.
And so what's been driving your our thoughts to be on the shorter end of the duration spectrum. What is the concern about interest rates?
At this point, the concern with interest rates is that the Fed is kind of caught in a tough spot because they're trying to handle an economy where they don't really know what's going to happen with inflation, but there's a number of inflationary pressures, and inflation would tend to be something that would drive interest rates higher.
Yes, I think that's the biggest consideration is, are we going to see inflation? And if so, how will it affect bonds specifically? And we saw that in the recent climb where bonds really did not perform as you might have expected as a flight to safety.
And so protectionist policies and uncertainty about the dollar as a safe haven are things that are impacting the duration spectrum interest rates.
Right.
Absolutely.
Okay.